Okay, so here's the deal. Moody's, yeah, the big one, just downgraded the U.S. credit rating from IA to AA1. That's huge. Why? Well, in their own words, this downgrade reflects the increase over more than a decade in government debt and interest payment burdens. In plain English, America's been spending way more than it's bringing in for years, and now the interest on that debt is starting to choke the system. And here's the kicker. Moody's also said, successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits. Yep, no one's fixing it. And that's a problem. Now, they did switch the outlook from negative to stable. That just means they're not expecting another downgrade right away. But the pressure? It's still on. So what does that mean for you and me? It means the cost of borrowing could go up. It means markets might shake. It means investor confidence takes a hit. But here's the thing. This is not the time to panic. It's the time to prepare. In this video, we'll break down what this downgrade actually means, how it affects your wallet, and how smart investors can protect their money and even build wealth while the system shifts. Let's jump in. Segment 1. What Moody's really said and why it matters. All right, let's rewind for a second, because before we talk about preparing, we got to talk about what actually happened. So, on May 16, 2025, Moody's, one of the top credit rating agencies in the world, downgraded the U.S. government's long-term credit rating. Not the outlook, not a warning, an actual downgrade, from AIA to AA1. Now, why does that matter? Because for over a century, the U.S. was sitting at the very top, the gold standard of credit. But Moody's just said, nah, we're not that confident anymore. Here's their exact words, and listen closely. This one-notch downgrade reflects the increase over more than a decade in government debt and interest payment burdens. In simple words, the U.S. is spending way more than it's earning, and the cost of paying back all that debt? It's getting heavier every year, and they didn't stop there. Moody's also said, successive U.S. administrations and Congress have failed to agree on measures to reverse large fiscal deficits. In simple terms, nobody in D.C. is fixing the problem. Not Democrats, not Republicans. Just more debt, more delay, more drama, every time the debt ceiling comes up. And here's where it starts to hit home. Because when the credit rating drops, confidence drops. Lenders demand higher interest to loan money to the U.S., and that trickles down to you and me. Higher mortgage rates, higher car payments, more pressure on small businesses, more volatility in the market. So yeah, this downgrade, it's not just some Wall Street headline, it's a red flag. And if history tells us anything, smart investors don't ignore red flags, they read them, they act. So now, let's talk about how to actually prepare and make moves that protect your money and build real wealth, even when the credit rating goes south. Segment 2. How to prepare as an investor, post Moody's downgrade. All right, so now that we know the U.S. just got downgraded, what the heck do we do with that? Because, let's be honest, most people hear this and immediately think, do I sell my stocks? Should I wait? Is a crash coming? But here's the truth. Smart investors don't panic. They position. So, let's break it down. 1. Don't fight the Fed. Watch the rates Moody's downgrade. It could push interest rates even higher over time. That means mortgages get more expensive, business loans get tighter, and credit cards, yeah, they get brutal. So step 1, lock in fixed rates wherever you can. Don't float your debt right now. And if you're investing, focus on assets that actually benefit when rates rise, like short-term bonds or dividend-paying stocks with strong balance sheets. 2. Diversify like it's your job. Listen up. Do not put all your eggs in one basket. If the U.S. economy wobbles, you want assets that don't all move the same way. We're talking gold, energy stocks, real estate investment trusts, REITs, and maybe even international ETFs, especially in places not tied to U.S. debt drama. Remember, diversification isn't sexy, but it will save your portfolio. 3. Emergency fund. No excuses. When debt gets dangerous, so does the job market. If you don't have an emergency fund, now's the time. 3 to 6 months of expenses, minimum. You don't want to be forced to sell your investments when prices drop. You want to hold, or even buy more, when everyone else is scared. 4. Don't follow fear. Follow fundamentals. Yeah, Moody's downgrade matters. But the real question is, are you investing in things you actually understand? With long-term value? With real cash flow? If yes, keep going. If not, it's time to get educated before you get emotional. 5. Build. Don't just react. The biggest mistake people make after news like this, they freeze, they sit back, and they miss opportunities. But this could be your moment to rethink your strategy and get ahead of the curve, while everyone else is distracted by headlines. So yeah, Moody's sent a warning. But if you're paying attention, that's not the end of the story. It's the beginning of your next move. All right, let's bring this all together. Yes, the U.S. got downgraded. Yes, debt is rising. And yes, things feel uncertain. But here's the truth. This is the best time to get serious about your money, your future, and how you react when the economy shifts. You see, fear? It doesn't build wealth. Clarity does. So if you've been waiting to get started, to finally invest, learn, build something solid, don't wait for perfect conditions, because they're not coming. Start small, stay consistent, and stay informed. Moody's may have downgraded America's credit rating, but that doesn't mean you downgrade your goals. In fact, this might just be your signal to upgrade your strategy. And hey, if you found this video helpful, smash that like button, hit subscribe if you're serious about building wealth in any economy, and drop a comment. What's your biggest concern after this downgrade? I'm reading everyone. Let's grow together. Stay smart, stay ready, and I'll see you in the next one.